Welcome to Built to Finish. I'm your host, Stephen Pivnik. Join me each week as we explore the journeys of audacious goal setters. This includes experienced founders, CEOs, and entrepreneurs sharing pivotal moments that propel their success. We'll also be talking with endurance athletes who push the limits of physical and mental ability. This show is brought to you by Acresis, offering tailored, high-impact advisory services to help founders get to their finish line with a strategic acquisition or majority investor recapitalization. Let's get started. Today's guest is an executive coach with over 20 years of entrepreneurial experience. As a strategic development expert, she specializes in business growth, finance, mergers, acquisitions, and development. In addition to guiding companies through key growth phases, she coaches executives and entrepreneurs to refine leadership skills, unlock potential, and navigate business challenges. Her combination of practical experience and coaching expertise makes her a trusted resource for business leaders seeking to enhance strategies and operations. She is a partner at the CEO Project. Pam Singleton, welcome to the show.
Thank you, Stephen Pivnik.
So happy for you to be a guest here. So I like to start these off with the end in mind. For you've advised a ton of entrepreneurs in your career. So with your private equity experience, you've been through a lot of exits and you've also advised a lot of entrepreneurs and founders on exits. In your experience, what are some of the key strategies that companies deployed in order to maximize the outcome?
Well, I guess I've seen companies over 20-ish years. So over my career, I have worked with companies from as an investment banker, representing them for exit, as a private investor, actually being a shareholder in these companies, and also being an operator, CFO, and I led sales and marketing and finance for many years. So I have a bunch of different perspectives on exits. The most important strategy from an operator and also as an investor is to make sure you have a great business model, recurring revenue, strong growth. You don't want to exit when that's not the case. It's really hard. It's really hard to exit without recurring revenue, as you know very well.
Painfully so.
Painfully so, and that lesson is indelible in your mind now. From the Also from that perspective is the importance of having a great executive team, an executive team that knows more than you do, and an executive team that can run the business while you are shopping, or you are shopping the company, so that the business doesn't fall apart and maintains its momentum. But also from a succession perspective, I think that's really important. You, as an owner, as a CEO, you want to make sure that that you have options at the end of the day. You don't want to have to be trapped to go along with the business if in the event that you don't want to.
Right.
And as a consultant looking in, think about the big picture. What's really important? What's non-negotiable? Do you want to go with the business? Do you not want to go with the business? With under other ownership. For example, if you sell outright, or you could sell part of the business and still be required to be involved. But really think through what do you really need, and what do you want, and what's non-negotiable.
So that's really good perspective. And you said a couple of things there, which I think are really key, which a lot of founders don't think that they have, but optionality, right? It's not a foregone conclusion that you're going to be going with the business upon sale. So you can actually create this optionality, but you have to do it way in advance of the actual event. So that is possible. And another thing you said, which I think is key, is bring a team on around you that knows more than you do. I think a lot of entrepreneurs and founders, want to be the smartest person at the table, and they're sometimes intimidated by folks that are smarter than they are. And I think that's the wrong strategy to have. It's going to help you tremendously, and it's not a sign of weakness in any way, shape, or form if the people around the table are smarter and more experienced than you are.
That was critical for your exit.
100%. And I found that when we hired for a certain position, it all of a sudden, raised the level of competence for the entire team. And when I looked around the table, I'll just use a CFO as an example, and the CFO started operating at a level above us all. Then I said, you know what? Maybe it's time to look at the next leadership position to see if I can, um, quote unquote, upgrade that position as well.
But it enabled you to think at a higher level too.
100%. It definitely gave me the opportunity to think much more strategically versus tactically, and many founders are just stuck in the day-to-day, tactical operations when they should be thinking at a strategic level.
Exactly. And every exits don't always have to be the sale to a strategic investor or a financial investor. So you don't always have to get PE and venture capital people involved. Sometimes an exit looks like a refinancing. So taking some money out, borrowing money from the business, and getting the bank to fund it. That was one of my clients had a great growing business. He had in his mind that he wanted a $200 million valuation. Um, and he was attracting PE money, but he didn't want the PE money to have a majority of ownership. And so time went on. Um, the banks were involved because it was a pretty big company. And at the end of the day, the bank would not loan against a company with family ownership.
Oh, wow.
So I mean, this is after 4 months of due diligence and, and heavy due diligence on the business model and all the other important things. But at the end of the day, the bank wouldn't do it. So what ended up happening is instead of the sale to a strategic investor, they ended up recapitalizing the company.
Okay.
Also through a bank, but it wasn't it was a different structure than PE backed.
Yeah, so, sounds like the bank discovering the family ownership was a, red flag for them, and I'm sure that's just one example of a ton of setbacks that you've probably seen during the due diligence process. I mean, their due diligence is fraught with setbacks. Can you share a couple of other stories on setbacks that you've seen and how they were overcome?
Uh, lots of times, um, lots of times you'll see uh, the negotiation process may start with the LOI, but it doesn't end until the money is in your account. Um, and it is a negotiation the whole way. You think the valuation is specified, but you find there are lots of ways to change that valuation based on the operating agreement or the sale agreement, the purchase agreement, and stuff like that. One of the exits we were looking for was it was actually this was an investment in a youngish company. So this was a private equity investment in a youngish company, and tons of due diligence, but we didn't do the due diligence on the private equity group itself. So the private equity group didn't actually have any money. It didn't have the capital.
Oh, wow.
It was in the middle of raising a fund, so when the time came to put up or shut up, it couldn't write the check. So that deal plummeted because of that, and that could have been easily overcome by really just finding out the source of funds for the private equity firm and qualifying the buyers.
That's actually great advice because, like, in my case, the LOI said that the company actually has the funds available to do this deal 100% in cash. And so it's something really good advice for founders to look out for, that starting with the LOI, it should indicate the source of funding for the potential deal.
Exactly. And also the payment terms, whether especially if there's an earnout, the valuation can change based on that earnout and your performance after the deal. So just because you think they're stipulating a $100 million valuation in the LOI, everything can change based on the structure of the deal. Really key is excellent legal representation. and in addition to your in addition to your investment banker.
I couldn't agree more. So you said earnout. Some entrepreneurs feel that an earnout is a lawsuit waiting to happen. Others look at it as a great tool to get them the valuation that they're really hoping for, but just in the future. In your experience, earnouts, good, bad, 50-50. What do you think?
As an investor, I love them because it makes the entrepreneur put their money where their mouth is. As an entrepreneur, you really have to be sold and well educated on your business to be able to make it happen. I think I've seen probably more that didn't work out than did work out. But boy, I've seen people blow the earnout out of the water in terms of favorably blow it out of the water. And wow, did they ever reap the benefits very quickly. And in fact, it was so quickly that they hit some of the other the later year earnout targets early, and they were able to get out from under the private equity firm very quickly.
Yeah, in my personal experience with an earnout, it wasn't with the final acquisition of my company. It was the asset sale that I did halfway through the company's life, and there was an earnout component. And there was two components to it. It was the first 6 months post acquisition, and then it was the second 6 months. To your point, blew it out of the water first 6 months. Next 6 months, not so much due to the dot-com collapse. But the one thing I would advise people to look out for is, control over however the calculations are being made. So if the calculations are based on EBITDA, make sure you have as much control as possible, over the expenses of the operation. If the calculations are based on top line sales, make sure you have as much control over top line sales, and that department is not working under somebody else who is outside your purview or outside your control. So the more oversight you have over the various levers for the earnout, the greater the probability that it's going to work out in your favor.
And relentless focus on whatever the terms of the earnout are. Just make sure you nail that first and foremost, and that you have a great strategy to nail it at the outset.
Yeah, 100%, because it's very easy if you're a founder and all of a sudden you get swallowed up by a larger company. There's going to be a lot of opportunities to do other things, and to many people that's going to be very exciting, right? Because you've been running your company, you've had like blinders on for the last how many years, 5, 10, 15, maybe more years, and now you're part of a bigger organization. And one thing entrepreneurs love are bright shiny objects, and there's definitely going to be an opportunity to work on bright, shiny objects as part of this bigger organization. But you should keep your eyes, laser focused on the earnout. And once that's over, you can go chase whatever you want.
Right, and focus on what you can control. I think it is a great point that you made. Lot When you have a private equity or even a venture capital investment in the firm, the investors are the ones who take over the negotiation of the deals. I mean, the entrepreneurs got some input, but largely the majority shareholder, who usually is the private equity firm, um, really controls things. And I hate to say this because it gives private equity a really bad reputation, but the private equity firm has investors and shareholders too, and it will do what it has to do, what is in its best interest to do,
Always.
whether or not it's in the company's best interest. So I've seen uh, really successful um, CEOs, professional managers, and entrepreneurs alike, who overperform, who perform exceptionally well, and then
Hmm.
get taken out just because the firm has a shakeup, or because they desperately need a sale in the portfolio, and so they whack back expenses and take out your entire management team, or three-quarters of your management team. But they will do what they have to do to get the outcome they need.
It's always, it's business. It's not personal. To your point, the PE will always do what's right for the PE and its investors. Period. Full stop.
And hopefully you're aligned with the PE, and everything goes great and you're hand in hand. But it doesn't always happen that way, unfortunately.
Agreed. Agreed. So I'm sure you've seen a wide variety of cap table and cap table messes, and that definitely throws a wrench into a lot of due diligence processes. What advice would you give on cap table maintenance?
Holy cow, manage the number of shareholders you have. That's the best advice I could possibly give anybody, because when you have to sell, chances are you need every signature, and tracking people down after a long time is really tough, especially if you had early stage investors. So when you have the opportunity to take out a handful of investors, do it.
I couldn't agree more. And this process needs to start years ahead of the actual sales process.
Years and years, yes.
Right? Because it's going to be very, very challenging to get an early stage investor to agree on a certain buyout when he or she knows that you're in the middle of a due diligence process. You're going to be held hostage. So starting the buyout process of early stage investors is really important, and it's going to be a lot cheaper if you do it way ahead of the exit. And the excuse you can make is, "Hey, I was just given advice to clean up my cap table, and this is why I'm making you the offer that I'm making you right now."
That's a great point. You don't wanna be that person who's about to close and has to chase down a shareholder who's on a cruise and or sailing, and, unreachable, basically unreachable, and need that signature to close. I've seen that happen more than one occasion, unfortunately.
Great advice for cap table governance. So, from a confidentiality perspective, as founders, go through the sales process and the due diligence process. How important is it to keep the process as confidential as possible? And like, who do you let into the tent and when?
It's interesting. I've always had that that's always been a challenge for most entrepreneurs. I saw it a completely different case with a company that had a dysfunctional family that owned the business,
Oh boy.
it went back to the CEO's grandmother found it, so it was decades and generations of dysfunction. And he had a fabulous business model of just in time delivering just in time construction components. And so he had the recurring revenue. He had some recurring revenue. Anyway, and a great pricing strategy, very high margins. He ended up. You would think it would be disruptive to sell the business, and he wouldn't tell the executive team, but he instead told everybody in the company that it was being sold, and the people were thrilled. So everybody was behind it, and it was a happy ending. I think, but for most companies, I think it's a distraction when you tell a lot of people that you're selling the business. There's Everybody thinks about what's in it, rightly so, what's in it for them, and how is this going to affect me? And uncertainty, change causes uncertainty, and people worry more about things that they don't have control over than things they do have control over. So lots of times, if you let everybody know, if you let people beyond the executive team know, it's very disruptive. That being said, I think it's important that the executive team know, yeah, who are these people coming in and visiting us? Why are you spending so much time out of the office with the CFO? You need the support of the executive team to get through the sale. What did you do?
Yeah, it's really hard. So we had a relatively small quote unquote tent at first. And just because for all the points that you just mentioned, I knew that it was going to be very disruptive. And we also operated in a highly competitive environment. And I didn't want news to leak out about the potential sale of the company because I knew for a fact that our competition would use it against us. They would say, why go with that company? They're about to be acquired. You want the stability of going with us. So I kept the tent incredibly small and only started widening it as we got into literally the final week of due diligence.
Mm.
And I was kind of disappointed that I shared the information with some folks that I thought would keep it confidential until the final finish line, and they didn't. So,
Ugh,
which is understandable, right? I felt a certain debt of gratitude for longtime employees, and I wanted them to be less surprised than the rest of the company. But at the same time, they had a certain amount of loyalty to their staff, and they felt that they needed to let them in on the secret as well. So it's kind of human nature to share and to gossip a little bit. But my advice would be keep it as confidential as possible until very, very close to the end.
right. Now, that goes to some of the employee discontent is realized after the sale. And one of our clients, or one of our mutual friends, had an exit, and he tried very hard to pay some of the people who'd been with him from the get-go, and was very generous with what he gave, or he felt that he was being very generous with what he gave them, and they were quite disgruntled after the fact, and actually made his life pretty miserable. Made a very happy event absolutely miserable with their reaction because they didn't feel like it was enough.
There's always an opportunity for that to happen, unfortunately.
Hmm. It's sad.
Yeah, speak about emotions, and what were some of the emotions that you've seen play out from a founder's perspective? Some are incredibly happy to finally realize the value of what they created. Others feel that their identity is being taken away with as part of the acquisition. What are some of the experiences you've seen?
Well, it runs the gamut. That friend we were just talking, mutual friend we were just talking about, had a government business, and he went through during the 20 years of being in business. It went through two government shutdowns.
Hmm.
He was thrilled and delighted to get away from the business, and which surprised me very much because his identity was largely wrapped up in the business.
Right.
He escaped his worst nemesis, the federal government. Um, let's see, with founders, um, it's a little challenging. It's their baby. You spoke in your book about having three children.
Right.
Yeah, the two girls and binary tree, and so it's a mixed. You have mixed emotions either way. If you stayed on, you risk getting tired and disenchanted with the business, and if you sell, you've lost your baby, lost control over it. But most I think most entrepreneurs, um, if they're not, well, let's make a caveat here. If if the entrepreneur sells to private equity and is required to stay on, that can get old very, very fast. They're used to not answering to anybody, and all of a sudden they have governance requirements. So I've seen people be absolutely miserable after having sold, cashed out to a certain extent, and still being under the watchful eye of the private equity. Sometimes, actually, the best advice I think I could give is on your first bite at the apple, when you bring your private equity or venture capitalist in, take take the money off the table as much as possible. Roll some of it forward, certainly, but you don't know when you're going to have another chance to take money off the table.
The only thing I would add to that is if you're working within a very experienced and successful private equity firm that has a great track record for subsequent exits of whomever they invest in, then there's a pretty good chance that the second bite of the apple may be as big, if not bigger, than the first bite.
I totally agree with you.
But again, that's pure speculation. I mean, there's past performance is no guarantee of future success, but there's a good probability there.
Right. I saw so one CEO with a private equity investment who in a professional services firm. He took maybe $500,000 off the table, and then was stuck working with a private equity firm. and really had a tough experience waiting for that second bite at the apple. So
Hmm.
do what you need to do to pay off your mortgage, fund the kids' college educations, whatever it might be, so that you do feel free to leave if the situation is untenable.
Yep. Agreed. Agreed. So let's switch gears real quick to the CEO project. I'll let you describe what it is. I'll just mention that I was a member in your group, and you were my advisor for 8 years. You helped me tremendously. So, with that introduction of how great it was, why don't you share, what the CEO project is?
So the CEO project works with CEOs to help them grow their businesses. So we work with you one on one, and then we put you in mastermind groups with other CEOs who are running businesses in the same stage of maturity, same businesses that have the same complexity.
So it's not necessarily the same industry or the same size, but it's same complexity and stage of maturity, which is key.
Correct, correct. It's actually, I think it's more important to have a heterogeneous group of companies. So you have services businesses in the same business in the same group as manufacturing businesses and software businesses and even a little bit of smattering of government in there.
Hmm.
Um, because different perspectives actually give you an objective perspective on your business. You don't have an objective perspective on your business, no matter who you are. You just don't. And having somebody who doesn't know squat about your business look inside actually is very powerful to give you unemotional, independent, productive advice. So the CEO project works with the CEO to help them identify the greatest points of leverage in their business and apply their time there.
Okay.
The greatest points of leverage in your business are your business model, how you go to market, what market you're in, how you differentiate the business, uh, recurring revenue, profitability. So business model, talent, your executive team, compensation of that executive team, organization structure, holding them accountable, and then focus on the key processes that make your business repeatable consistently without being dependent on key employees, and then on the points of constraint in the business. So what's really holding you back from growing? Is it related to business model, talent, or key processes, or is it something entirely different?
Awesome. I mean, again, I can't thank you enough for the 8 years that I spent in your group with your tutelage and mentorship helped me and my company tremendously. I'm honored to be a partner with you now in the CEO project, facilitating a mastermind group of my own. It's a lot of fun, and I kind of compare it to being a grandparent. I'm not a grandparent yet, but when you're a grandparent, you get to borrow the baby, play with it, spoil it, and then give it back.
That's very true.
So I get the privilege and pleasure of working with CEOs and entrepreneurs and working on their problems, their issues, their challenges, giving them advice, and then I get to go away and they go implement the advice.
You and I both know that you're emotionally invested in the client, and no matter what silly decision they might make, you're going to support them and help them make the best of it. So the bond is eternal.
Well said, and you know more than most the silly decisions that I've made over the years with the company, but you are 100% right. You supported it wholeheartedly. Thank Fortunately, most of them were good decisions, but there were some doozies in there for sure.
No, you had very few. You were actually very wise, especially in hindsight. You were looking very smart.
Thank you. I appreciate it. Well, Pam, I can't thank you enough for being on the show. I think you've given listeners a ton of great advice. Where can people contact you?
Pam Singleton at theceoproject.com. Our website is theceoproject.com, and I'd love to hear from you.
Great. Thank you very much for listening. If you found this episode useful, please like and subscribe. And if you think anybody in your network would benefit from the information shared today, please do share this episode with others. Again, thank you, Pam, for being on here, and thank you, everybody, for listening. That's a wrap for this episode of Built to Finish. Thank you for tuning in. For show notes and more details, head over to podcast.stephenpivnik.com. Special thank you to our sponsor, Accresis, offering tailored, high-impact advisory services that help founders get to their finish line with a strategic acquisition or majority investor recapitalization. Catch you next week.